We found 114 new insider trades. Almost every single one of them is going to be totally useless, but we'll look through them all to find those few that could be high signal and help us outperform. As a quick reminder, what constitutes a high signal trade? We're looking for unscheduled and unusual insider trades. So we're ignoring all the things like tax sales, dividend reinvestments, employee stock purchase plans. We're looking for unusual timing or an insider flipping from buying to selling or anything along those lines that could mark it as an abnormal or an unusual trade. And then a big plus is if the insider has a history of success, and then the size or quantity. If you've got multiple insiders buying the stock or they're abnormally large or small, that could be interesting. And then the price action, if they're buying the dip, for example, that is always a good sign. Taking a look at today's data, we can see again very little buying, a little more selling, which means we're going to be very, very low in the percent of total insider trades that are buys. Again, entering earnings season, don't think this is a huge red flag. Definitely, slightly bearish maybe, but every earnings season we're going to have this. We're going to have fewer trades and they're going to be mostly sells, as insiders are not allowed to make discretionary buys right before their earnings. So nothing to be too worried about, I don't think. As we look on the weekly, of course, we're going to be down quite a bit, but again, I don't think this is a huge red flag yet. We're just a little, maybe a tiny bit bearish, but entering earnings season, nothing too much to worry about. Let's head over to CEOWatcher.com and go take a look. We'll start with the insider buys, get the most recent data coming in here, select purchases, and then we'll sort by transaction value. Starting at the very top here, I think we actually discussed this one yesterday, so I won't really go into it too much. We've got a director at Scholar Rock Holdings buying $18 million of the stock. Obviously a very big holding, or a very big purchase. I mean, $18 million is certainly going to be this insider's largest purchase, which we can just take a look at their previous ones. We can see here, if we scroll over $18 million, the only trade that was bigger was this $35 million sale back in 2024 as part of a 10b5-1 plan. But in this case, we've got an $18 million purchase. It's not scheduled. It's the largest purchase ever. Their first purchase at this stock in about a year. Let's take a look at the Form 4, see if there's anything here. So doesn't look like there's any red flags in the Form 4 itself. He is buying it on behalf of Samsara Opportunity Fund, but that is perfectly fine. So overall, a very large trade. The insider appears to have decent returns. So if we just look historically, 6% 1 month, 20% 3 month, 30-ish, almost 30% 6 month, and 66% 1 year. About 50-50 on the win rate. So not a great win rate, but when they do win, they win quite big. So overall, this was a pretty good one. As I mentioned, we talked about this one a little more yesterday, where basically they had FDA approval. Just looking at my notes real quick, they had FDA approval on the drug that was delayed because of some third-party manufacturing issues. However, their drug still should get approved, so there's just a delay here, which obviously is a little bit concerning that there is a delay, but the price action has been really strong, and it looks like that approval is still going to come in the next 6 to 9 months, and they also have a decision in Europe that should come by mid-2026. So all of that is they're able to start manufacturing, I guess, yes, and selling and commercializing their product. Obviously, could be a huge win for them, assuming that goes well, so that's kind of the main catalyst there. Any other catalysts? They have a financial runway into 2027, another trial enrollment starting in Q3 of 2025. They have another filing expected in the back half of this year, all of which, probably not going to be big catalysts, but could be slightly beneficial for the company. So overall, I think this one's pretty interesting. Watch yesterday's video to get the full rundown of that. ASA Gold, this is one we've looked at about 100 times because Saba Capital Management continues to buy it. We started looking at it way back here. I personally bought, a gold and a few gold miner stocks on this. I didn't actually buy ASA, but bought some related ones because of all this insider purchasing. They bought the stock a ton. They've been pretty good historically about their cluster buys, which I guess was really only back here at the end of 2023, worked out pretty well. And then they did take a little break here, a 2-week break where they didn't buy, but just started buying again. So that's kind of interesting to see with the stock already up 40% since they first started buying. It's interesting to see them continuing to buy and apparently continuing to have some faith there in gold prices continuing to go up. But obviously it's been on a run. They bought the stock 18 times, $53 million or something like that. Pretty interesting. So FactSet Research, this is a very, very interesting one because if we go to take a look at FactSet Research stock here, we can see obviously fell off a cliff here, which this is kind of the, trifecta for bad performance as you've got EPS estimates falling. You have a bunch of, which we will see if we click into FDS here, FactSet Holdings, a bunch of insiders selling back here up in kind of the summertime time, especially right around here. In the summer of 2025, we also had the CEO stepping down. So you've got insider selling, and then you've got the estimates coming down, and I mean the CEO stepping down is another one. But then obviously there's just concerns about AI both eating into their margins and competition, because this is a very, very expensive data company, and if you can just ask ChatGPT and get good enough quality answers, then that's kind of I don't know how much I buy necessarily into that argument of it, but we can definitely see that the margin concerns at the very least were accurate, because if we take a look at their earnings call, we take a look at some of the revenue growth was fine, organic annual subscription value was increasing, organic revenue growth was increasing. They had their largest quarter in terms of subscription value growth. Their operating margins, though, you can start to see now slight margin compression, full year guidance margin within the guidance, but full year adjusted EPS within guidance is also low. But then you start to get into EPS declining a little bit and a conservative outlook among longer sales cycles and investments, which this investment is due to AI investment here. So it's costing them a little bit more money to serve some of these things. So we start to see a little bit of margin concerns there due to the AI increasing. And then they also do mention maybe some headwinds. Let's see, let's look at operating margins includes higher technology and content costs. So obviously you can see there. And then anything else here that they mention, growth expected from AI and data expansion, but they do give a conservative outlook on EPS there. And then so current environment is characterized by longer sales cycles and more rigorous client technology approval process. So we start to get into, and then you got the competitive dynamics in AI. So here and then the third one, pricing pressure. But these are kind of the main ones. Is this one, I don't know how many people actually saw coming, the longer sales cycle, but that was a negative there. Maybe more of a macro statement there, with kind of and just companies being a little more tight with their spending. But you've got competitive dynamics, more AI entrance into the field, and then just generally speaking, like AI and the ability to get answers really quickly through things just like straight up ChatGPT, or through some of the more narrow niche products that are more directly competing with FactSet. And then you've got some margin pressures, which was all the concerns. However, here you go. How much of the margin decline due to investments versus cost inflation? The majority was from higher bonuses and acquisition dilution. For next year, though, 2.5% of margin impact is expected, with most of it from growth investments. So we're now at the point where basically the argument is essentially, do you still think that these negative dynamics, I guess the worse margins, the AI competition and stuff, do you think that is even worse than anticipated, or is it mostly priced in now that the stock's down 36% in the last 3 months? Is kind of the whole argument here. Is like, yes, all the numbers and the story and everything not great, but a lot of that appears to maybe have been priced in. And then you can go just look at valuation numbers here, and you can see trading way down over, this is over 20 years, all the way down since last time they've been at these PE multiples was back in the 2008 crash. So a lot of negativity priced into this stock here for sure. Probably rightfully so in some cases, but we are now starting to see some insider buying. We've got these two insiders, this is the CFO and this is the chief legal officer, both buying $100,000 of the stock after a stock dip at low valuations. Always a compelling setup, and frankly one of the more compelling setups that you're going to see is insiders buying the dip at low valuations. So kind of just comes down to how worried you are about FactSet going forward. If you wanted to be really prudent, you could probably wait till next earnings and see how the next earnings call goes, and see what they mention about, are they winning more business because their AI deals, basically is that margin compression being beneficial in more revenue coming in and being able to charge customers more, or win new customers or retain more customers because of that AI investment. And then what are the competitive dynamics looking like? Is their lunch getting eaten by, a bunch of up and coming competitors? Always a concern. So that's kind of the story, but overall from an insider trading standpoint, this is a very, very compelling setup. Anything else interesting here? We've got Mink Brook Asset Management, who's been continuing to buy DLH holdings here. The stock is up quite a bit now over the last 6 months, 60%, and they've been buying that whole way. Pretty much flattened out over the last 3 months, as you can see. It's been flat for quite a while, but I don't know if there's much for us to do here. You got a 10% owner that's just been buying tons and tons of the stock. Obviously would have been a little more interesting back here, but I don't know if we would have really thought much of it because they have no history. Prior to these purchases, they were never really buying the stock before. 10% owners aren't the most interesting. So I don't know if there's much for us to do with that one. And then another one we can look at here, Silvaco Group we're going to see the first, I believe, let's take a look here. We'll see the first insider buying. Let's just take a look at the chart here. So the stock is down 50% in the last year. We got but it is up 40% in the last 6 months. We had, let's see who we've got here buying $60,000 of the stock. We had a director buying the stock. We now have the CFO buying the stock, who is a relatively new CFO here. I think just joined maybe last month or something. Now, a couple things we're going to notice right off the bat. $25,000, not a very large purchase, but this is, most likely a pretty small company. So I'm not actually too concerned about only a $25,000 purchase. $190 million, so pretty small. You start to see the price momentum actually moving in the right direction, even though earnings estimates not moving in the right direction. So you do have a little positive momentum here. So here we go. Appoints that guy as the CFO. Just happened literally a month ago. However, the CEO just left recently, and here's kind of the concern here. So obviously, this is a turnaround play, which normally speaking, in big turnarounds where companies are down like 50% in the last year, in this case, you do actually want to see executive turnover. You want for some reason the executives that are currently in place having a brand new strategy and that being compelling. If not, then you want those insiders out so you can get some, or you want those executives out so you can get some new executives in and you can start to turn things around. Now, if we look here, you can see massive revenue declines, massive booking declines, down 19%, down 34%, which they do mention is that some orders shifted from Q1 to Q3 and Q4. Their margin declined, which just was due to lower revenue and then higher fixed costs because they were making some acquisitions. So overall, you just kind of go through this stuff and it's not looking particularly good. Let's see what else we have here. OpEx. So you've got OpEx rising, which as they mentioned is why their margins are coming down while their revenue is going down. Like not quite stuff you want to see there. So then as we start to look at, apparently they've been doing a bunch of acquisitions. But one thing we'll notice down here, they do have some dealings with China, which obviously presents some of a concern given lower results so far. So they actually guided pretty aggressively, which let's see if they mention it in here. Doesn't look like, I'm sure we could find it in one of the other ones, so it's not really super important. But they guided fairly aggressively, basically banking on what we had mentioned up here, which was that the Q2 bookings are down, but some orders shifted from Q1 to later in this year, and they're basically banking on Q3 and Q4 guidance, recovery of delayed orders, and macro improvements, especially in Asia. Which, frankly, when you're an executive, I feel like if you have the chance to lower guidance, it's kind of a gift in a sense, because then you have less, you have a much higher chance of beating, sandbag guidance going forward. So the fact that they didn't lower guidance even with terrible Q2 numbers is kind of interesting. And they're obviously now expecting a recovery of delayed orders and macro improvements. On the flip side, them actually getting these, if those two things happen, they have a pretty good chance of earnings going well, which that would kind of be the whole bull case here. Is you've got the CFO buying $25,000 of stock. This quarter is pretty much baked. They should know the numbers by now because the earnings is in less than a month already. Quarter should have ended September 30th. So they know the numbers coming out. They do have aggressive guidance that they are going to try to hit, but they do have the potential tailwinds of improving macro environment in Asia, which that in China specifically is that could change at any moment. But then expected recovery of delayed orders coming in would be a benefit. However, the downside here is that we have the CEO then got fired literally a week after earnings, or 2 weeks maybe, 10 days or so after earnings. The CEO got fired. So now you I don't know how much you can really take those earnings, or whether or not you have to take them with a grain of salt. So that kind of throws a whole wrench in this. Generally speaking, I'm a fan of kind of those turnaround insider buying plays, especially when you've got the earnings coming up and all of that. But I do think, and frankly, like I mentioned, I actually like management changes in these turnaround companies. However, we haven't heard anything from the new management yet. And the fact that the previous management was the one kind of setting the stage here for improving guidance and things turning around in Q3. The fact that he's no longer in charge kind of throws a wrench in that whole situation. So I could see it going both ways. Obviously, generally speaking, the insider buying, the earnings dip is a positive, but you could also see it as like with the new management team coming in, or the new CEO at least, they could use this next earnings call as kind of an opportunity to sort of reset the stakes here and maybe not perform so well in that earnings, but setting themselves up better for the future. So I don't know, this one's a tricky one for me that I probably stay away from, though I could see it actually working out quite well. So that's kind of a tough one. I think for the most part, that's most of what's interesting there. We've got this one could have been interesting, but just buying phantom stock here is kind of which is payable in cash following the person's termination of employment with United Bankshares, which this could actually be interesting from a corporate governance standpoint. It's not something we currently focus on too much right now, but this would be the kind of thing you you'd start to look for when you're trying to see like companies that might be getting bought out soon. That you'd start to look for like changes in their compensation, changes in sort of the type of shares they're getting or buying in this case. So all of that could be interesting. They don't even tell you what price. Oh yeah, they do. $37. What's the price range? So he was paying 37, so about the same price. So nothing too unusual there. You see a bunch of insider trading that's, you know, just pretty consistent buying. I don't know if there's anything of note there. So that could be interesting if you kind of went back through and looked at this guy's previous grants or purchases just to see if anything's interesting going on there, but not really something that we've looked at much for CEO Watcher stuff specifically. So just skipping that one for now, but always interesting to see. You don't see very many phantom stock units being bought or granted or anything. They just don't show up that much. So kind of fun to see. Moving on to the sales here, we're going to see, I mean, as we've been seeing, a lot of the sales, a lot of them just look kind of the same. We got more selling by Magnetar at Core. We've got more selling of Dell by SLTA Group. We've got more selling of T-Mobile by Deutsche Telekom. Lilly Endowment selling Eli Lilly. Bunch of 10b5-1 sales as always. And then we finally start to get down to maybe some semi-interesting ones. We've got Planet Labs here, which this stock has obviously been on an absolute tear. One of the most popular, hottest stocks out there. 600% in the last year, 100% in the last 3 months, 300% in the last 6 months. Now it is kind of interesting. This is the first insider sale of any size. All of these are just kind of little tiny rinky-dink single $1,000 sales. This, I assume, is back when they IPO'd, back, yeah, kind of post-IPO dip or whatever they did, SPAC maybe. So this is really the first insider sale that we've seen, which is notable, and it's $5.9 million, 44% of the person's total holdings. It's a director here, must have, you know, his previous sales don't look like they worked out too well. If we go take a look, would have been at Zendesk, selling in 2020, obviously did not work out too well. Zendesk back here, stock went on a tear after selling, so not a good track record for this guy, but interesting to see a massive sale here. However, as you got, I mean, look at this, you got earnings estimates falling while the stock is taking off. You have, I'm sure if we go look at historical valuations, they're going to be just like a sky high, which they don't have any earnings, so there's not much you can really measure them on except for EV sales, which is, you know, sky high at 14x and about as high as it's ever been for them, except for maybe right when they IPO'd and right after the IPO kind of beginning timeframes there. Or I guess this is just back to 2021. So at one point in 2021, they were selling, you know, slightly more expensive. But overall, yeah, I guess that was right when they IPO'd and they just had less revenue probably. They were trading, you know, at a higher multiple. But overall, trading at a very high multiple right now, as we can see, they have before gone on a tear where they got way above the 200-day before they fell all the way back down to it. Almost certainly this is what's going to happen again, is this thing is going to eventually at some point, who knows when, fall all the way back down to here. The problem is, if not further, depending on how the economy goes. But the issue being, you don't know, you know, you probably could have said the same thing here, and then you could have said the same thing here, and then you could say the same thing now, and it could keep going. Trying to time these type of plays is just so hard, but this is very clearly a super expensive stock with now our first insider selling. It's gonna turn over at some point, and it maybe could be an interesting short if you are somebody willing to take the risk on that, but trying to time it is gonna be brutal, and you'd much prefer timing it, you know, you're much safer trying to time it down here, you know, after it is very, very clearly rolled over than trying to get it way up here. So, you know, right now for me, there's just nothing we can do there. Even though this is a semi-interesting insider sale, there's just nothing to do with the stock that's on that much of a tear, and trying to fight that momentum is a quick way to get you to lose a whole lot of money, which is actually a pretty similar setup, which we can end. We're just looking through, there's not much more here. You know, Carvana CEO is always selling the stock, tons of 10b5-1s, bunch of tax sales, not a ton going on here. But if we look at Argon, this is another one that's in a similar-ish boat, and kind of there's a whole group of stocks actually in this boat that we've talked about quite a few times. But you can see insider selling starting to pick up here. Stock on a tear, 150% in the last year, 100% in the last 6 months, 500% in the last 2 years. Insiders selling sizable amounts of their holding, selling sizable dollar amounts. But as you can see, they've been selling, you know, they're selling here, they're selling in chunks back here, and the stock has continued to go up and go up and go up because, again, they are in construction engineering, but what are they constructing in engineering? The power generation market, which obviously has now become super hot because of all the AI data center stuff. And now, I'm assuming they're going to be trading at very high multiples again. So, I mean, all of these are like EBITDA numbers, earnings numbers, sales numbers, all of those things have to go very, very well for these returns to enter, to fall back down to normal, which, you know, there's a lot of money sloshing around in the AI world right now that might get there. But if it doesn't, moment, right? If there ever starts to be a kink in those stories, which in this case they at least have earnings going in the right direction, unlike Planet Labs and unlike some of the other power generation companies, they at least have earnings going in the right direction. But again, we're more likely somewhere in this region where it's going to eventually come back down. But again, maybe we're right here or something, and then all of a sudden it takes off on you again. Any news of them partnering to provide power to any AI company is going to cause the stock to go. So you have a super high momentum stock in a super high momentum industry with tons of potential tailwinds. Super expensive, lots of insider selling. But again, there was insider selling back here, and the stock is up another, whatever that would be. The stock's up another 30% since then or something like that. So it's all about timing. Everybody knows these stocks are overvalued. Everybody knows they have to come back down to reality at some point, but you can lose a lot of money trying to time that properly. So tough to do. But overall, most of the insider selling today, not super interesting or compelling, but you can go to CEOWatcher.com and take a look at all the insider trades for yourself. Don't forget to like and subscribe, and we'll see you next time.